Welcome back, everyone. Today is March 30th, 2026, and if you're an APLD shareholder, you're probably looking at a sea of red. Applied Digital stock dropped 13.53% today, closing around $20.55. So, what caused this sharp sell-off? It really comes down to two main factors: pre-earnings anxiety and shifting market sentiment. The company is set to report fiscal Q3 earnings on April 8th, and investors are getting nervous. We're seeing increased demand for protective put options, which signals that traders are bracing for potential downside. There are growing concerns that the company's heavy spending could overshadow its strong revenue growth. This comes after an already volatile month, where the stock pulled back about 16% following a massive $2.15 billion debt offering earlier in March. To understand today's drop, we also need to zoom out. In 2025, APLD surged over 200% as it pivoted from crypto mining into AI infrastructure. But 2026 has been much more volatile, with the stock peaking near $42 in January before pulling back sharply. There are a couple of key reasons behind this. First, reports in early March revealed that NVIDIA exited its stake in the company, which shook investor confidence. Second, the company has taken on nearly $5 billion in total debt to fund its massive Polaris Forge campus. Every time new financing is announced, investors worry about dilution and rising interest costs. Now here's where the story gets more interesting, because Applied Digital is going through two major strategic transformations at the same time. First, the company is transitioning into a data center REIT. The goal here is to become more like infrastructure giants, focusing on stable, long-term cash flows instead of speculative growth. They are securing 15-year, non-cancelable leases with major hyperscalers like CoreWeave and Oracle, which could provide very predictable revenue streams. They're also using what they call asset-level financing, including a massive $5 billion facility from Macquarie, to fund individual campuses. This approach reduces the need for corporate-level dilution and aligns with a REIT-style structure. To fully qualify as a REIT, Applied Digital is planning to spin out its more active cloud services business into a separate entity called Chronoscale. This allows the core company to focus on passive, rental-like income from data center infrastructure. Management is targeting over $1 billion in net operating income within the next 5 years as these campuses ramp up, which would be a major step toward profitability. The second major transformation is the explosive growth of its AI hosting business, which is now the primary engine of the company. In its most recent quarter, revenue reached $126.6 million, up 250% year-over-year. The high-performance computing segment alone generated $85 million, driven by demand for AI-ready infrastructure. The company has also built a massive $16 billion contracted backlog. This includes an $11 billion deal with CoreWeave and another $5 billion agreement with a large investment-grade hyperscaler tied to Polaris Forge 2. On the operational side, progress is underway. The first 100 megawatts at Polaris Forge 1 is already live. Another 150 megawatts is expected by mid-2026, and Polaris Forge 2 is scheduled to bring an additional 300 megawatts online between 2026 and 2027. Now, let's talk valuation. Is the stock cheap after this drop? On one hand, revenue growth is extremely strong. On the other hand, the company is still not profitable on a GAAP basis, and its price-to-sales ratio has been as high as 28 times. Some analysts believe the stock is significantly overvalued based on current fundamentals, meaning investors are really betting on future execution. Despite today's decline, Wall Street remains relatively optimistic. The average 12-month price target sits between $45 and $50, with some bullish estimates as high as $58 and more conservative views in the $30 range. Long term, if Polaris Forge is successfully executed, some projections suggest much higher upside by 2030, but those are far from guaranteed. So is APLD still a buy? It really depends on your risk tolerance. The bullish case is that Applied Digital is positioning itself as a key infrastructure provider in the AI boom, essentially selling the picks and shovels needed to power artificial intelligence. But the risks are real. Execution is critical. Any delays in construction, issues with scaling operations, or problems managing that $5 billion debt load could put significant pressure on the stock. There's also concentration risk, since a large portion of revenue comes from a small number of clients like CoreWeave. Bottom line, all eyes are on the April 8th earnings report. Investors want to see continued progress on Polaris Forge, strong demand for AI hosting, and clear signs that the company can manage its balance sheet effectively. This is not a low-risk stock. But if you believe in the long-term growth of AI infrastructure and are comfortable with volatility, it's definitely one to watch. Thanks for watching. If you found this helpful, please like the video and subscribe to the channel. I'll see you in the next update.